Thank you for joining Kentucky Public Pensions Authority Pension Spiking webinar. My name is James Isaacs, and I'm a retirement benefit consultant within the Division of Member Services in our Training and Outreach branch. Joining me today is a KPPA representative that will manage your questions within the Q&A forum. Please keep in mind that Kentucky Revised Statute 61.661 requires KPPA to administer accounts in a confidential manner. During our webinar today, please do not submit questions specific to your account and do not post sensitive information such as your KPPA member ID, Social Security number, or PIN in the Q&A forum. If you have specific questions about your individual account, please contact KPPA with your 4-digit PIN at 1-800-928-4646 and speak with a counselor. During today's webinar, we'll have a brief Zoom tutorial, define pension spiking, and give a brief history of how it has changed in the past 10 years. We'll then cover possible exemptions, how it is integrated into your benefit, and how the spike can be removed or modified. We'll be covering a lot of information today, but hope you find this information helpful. At the bottom of your screen, you should see your Zoom toolbar. The three functions available to the attendees are Raise Hand, Q&A, and Reactions. At the far right hand of the toolbar, you'll notice an option to leave meeting. At any time throughout the presentation, you may exit the webinar by clicking Leave. If you are unable to stay the duration of the webinar, we do encourage you to register for another webinar in the future. The question and answer function is used to ask general retirement questions to the KPPA representative. We ask that you be patient with us, but we promise to answer every question before the conclusion of the webinar today. Q&A ensures that no question will go unanswered, and we encourage you to interact with the KPPA staff. To prevent interruption and allow the webinar to end on time, we will not be using the raise hand function. While we encourage your interaction with the KPPA staff, we find that oftentimes we will answer your questions throughout the presentation. It's helpful to jot down your questions and ask about them at the conclusion of the webinar if those questions go unanswered. Our starting point today will be to define pension spiking for retiring members of the KPPA systems. A shortened definition, according to KRS 61.598, is as follows. For employees retiring from the Kentucky Employees Retirement System, the County Employees Retirement System, or the State Police Retirement System on or after January 1st of 2018, the systems shall, for each of the retiring employees' last 5 fiscal years of employment, identify any fiscal year in which the credible compensation increased at a rate of 10% or more annually over the immediately preceding fiscal year's creditable compensation. The employee's creditable compensation in the fiscal year immediately prior to the employee's last 5 fiscal years of employment shall also be used to compare the initial fiscal year in the 5-year fiscal year period. Any amount of increase in creditable compensation for a fiscal year that exceeds 10% more than the employee's creditable compensation from the immediately preceding fiscal year shall not be included in the creditable compensation used to calculate the retiring employee's monthly retirement allowance. When you retire, or when you see a benefit estimate in Member Self-Service or from our office, the system will compare your high 5 or high 3 salaries and then overlap them with the last 5 salaries at the time of retirement. If any of the last 5 years in the high 5 or high 3 have salaries that are 10% higher than the preceding year, the amount for that year will be capped at the 10% amount. There are several exemptions in place that will either allow the increase to be used in your final compensation, as well as a $25 across-the-board exemption for all members that may reduce or eliminate any spiking penalty. So what is creditable compensation? It is defined as earnings that must be reported to KPPA and is used to calculate retirement benefits. It includes all wages, salary and tips, lump sum bonuses, severance pay, and employer-provided wages for service purchases. It also includes any alternate sick leave payments if the agency participates in the alternate sick leave plan, and includes compensatory leave payments for Tier 1 employees. It does not include living allowances, reimbursements for expenses or travel, per diems, or lump sum payments for annual leave or for standard sick leave. Now that we have explained what spiking is, let's look at the history of spiking over the years. Pension spiking first came about as a result of Senate Bill 2, enacted by the General Assembly in 2013. This created KRS 61.598, which to this day is the pension spiking statute. It became effective January 1st of 2014, and it placed a financial burden of any spikes on the employers of the member who spiked. If there was a spike detected, KPPA would bill the employer the actuarial cost for the retired member to receive the extra benefits from the spike. The retired member's payment was not impacted. This version of spiking was in effect until June the 1st of 2017. Senate Bill 104, passed in 2017, changed how pension spiking was handled, placing the financial impact on the retiring member instead of the employer. It reduced the credible compensation for any year that exceeds 10% more than the previous year, and it refunds any contribution to the member that is a result of that extra credible compensation, and more exemptions were added. So what are the allowed exemptions? When pension spiking was first enacted, the exemptions were limited to the members who received a greater than 10% yearly increase due to a bona fide promotion or career advancement, or if the member received a lump sum payout of compensatory leave at termination. When pension spiking changed in 2018, additional exemptions were added. These included lump sum payouts for alternate sick leave, an increase in salary due to being on leave without pay, increases due to overtime work as a result of federal or state grants, or increases due to a federal or state declared state of emergency. In the 2021 General Assembly, an additional exemption was added that allows for a $25 monthly payment exemption. If the reductions in credible compensation during a retiring member's entire last 5 years of employment results in a reduction in his or her monthly retirement allowance of less than $25 per month, or an actuarially equivalent value under the various payment options, then no reduction in credible compensation or retirement allowances shall occur. In 2022, more exemptions were added. The first new exemption allows the first 100 hours of mandated overtime in a fiscal year to be exempted from the pension spiking determination. The second expanded the state of emergency provision and allows for overtime work due to a local government declared emergency that requires deployment of the Kentucky National Guard. Now that we know what spiking is and we've gone over exemptions, let's look at how a spike is determined and calculated. To understand how a spike is calculated, it is important to understand how your monthly benefit is calculated. The formula to determining a member's basic benefit is the years of service, multiplied by a benefit factor, multiplied by the member's final compensation. On the slide, you can see the final compensation for a Tier 1 non-hazardous and Tier 1 hazardous member. To determine the final compensation, add all the salaries in the 5 highest or 3 highest years. These are the years with the highest average monthly salary, and we'll divide that by the number of months represented by those years. In our non-hazardous example, the total salaries equal $186,297, and there are 49 months in those 5 highest years. When we do the math and determine the average, the final compensation is $45,623.76. For the hazardous example, the total salaries equal $106,995, and there are 25 months in those 3 highest years. When we do the math and come up with the salary average, or final compensation, it equals $51,357.60. The first step in calculating a pension spike is to find and evaluate the 5 years that are the highest monthly average. In the example, we'll assume that the member's last 5 years are also the highest 5 years. Year 1 is the most recent and highest year, and the years go back to 5 years ago. As you can see, the salary increases from fiscal year 4 to fiscal year 3, increases again from fiscal year 3 to fiscal year 2. The final compensation for this member is the average of these 5 years, or $16,816.12. The system has determined that there is one spike. The salary in fiscal year 2 is a 14% increase over fiscal year 3. The increase between year 3 and year 4 is only 7.8%. Because each year in the last 5 salaries has a potential cap of 10% over the previous year's salary, the salary of year 2 has been found to be in excess of that cap. To determine what the maximum amount may be for that year, we will multiply the previous year's salary by 10% and then add it to that salary. 10% of $16,333.25 is $1,633.33. This is then added to the $16,333.25 to create a new Year 2 salary of $17,966.58. The difference between the spiked salary and the unspiked salary is $728.42. This amount may not be used in determining the final compensation due to the potential spike. In the original calculation, the final compensation, using the unspiked salaries, was $16,816.12. When the new fiscal year 2 salary is substituted in, the revised final compensation is $16,670.43. If the reduction in creditable compensation during a retiring member's entire last 5 years of employment results in a reduction in the monthly retirement of less than $25 per month, the spike will be disregarded. If the results calculate a difference in monthly benefits greater than $25, the final compensation will be updated to reflect a $25 reduction in the spiked monthly amount, or the member will receive $25 more in the monthly benefit than the spiked amount would reflect. So let's look at the comparison between the two basic amounts for this member. For the purposes of the calculation, let's assume the member has 27 years of service and is CERS non-hazardous. This would give them a 2.2% benefit factor. We will perform two separate calculations, one using their full salaries and one with the salary of $18,695 reduced due to the spiking. The reduced amount compared to salary 3 is $17,966.58. The final compensation changes from $16,816.12 to $16,670.43. Since the years of service and benefit factor are the same, the annual basic benefit changes from $9,988.77 unreduced to $9,902.24 when reduced. The monthly amounts change from $832.40 to $825.19, or a $7.21 difference. Since $7.21 is less than $25, which is the exemption, the member will not be subject to spiking, and they will receive the full monthly benefit of $832.40. Now let's look at a member whose adjusted basic amount exceeds $25. For the purposes of this calculation, let's assume the member has 34 years of service and is KERS non-hazardous. They would have a 2% benefit factor. We will again perform two calculations, one with full salaries and one with a salary of $7,381.52 reduced due to spiking. The reduced amount compared to salary 3 is $54,412.09. So the final compensation changes from $54,698.81 to $53,986.14. Since the years of service and benefit factor again are the same, the annual basic benefit changes from $37,195.19 unreduced to $36,710.58 when reduced. The monthly amounts change from $3,099.60 to $3,059.21, or a $40.39 difference. However, $25 of the monthly basic benefit is exempted from the spike, so the member will receive $3,084.21, or $15.39 less than the unreduced amount. Even though on the surface it looks like it is a lower salary, a partial year may cause a spike. As you can see in our example below, year 1, or the highest year, has a salary of only $5,000. However, it is only over 1 month of service. Year 2 has a salary of $50,000 over 12 months. When you compare the two monthly averages, the average salary of year 1 is 19.99% higher than the salary represented in year 2. As a result, this would be a potential spike. Some salaries may not even be in your high 5, but cause a spike. Because the statute states that the last 5 salaries are compared to the previous year, it is entirely possible that the 6th year may be the one that causes a spike. As you can see below, year 5 is the lowest year in the high 5, but is compared to the salary in year 6, which was from the previous year. The monthly average for year 5 is 19.99% higher than the monthly average salary for year 6. As a result, there is a potential spike from year 5. When you receive benefit estimates from the KPPA office, there will be 2 different estimates if a spike is detected. The first will display all information and salaries with no spikes assumed. The second will display with revised salaries due to spikes and adjusted to reflect the $25 payment exemption. You will also receive a letter that explains which year or years were subject to the spike. If you receive multiple estimate scenarios, there will be a side-by-side comparison for both the spiked and the unspiked estimates, as well as multiple spike letters. When you receive your final retirement paperwork from the KPPA office, there will only be one set of paperwork if a spike is detected. If a potential spike is found, the paperwork will reflect it. We will send you the letter that explains where the spike was detected. We will also send paperwork to your employer to clarify if any of your spike salaries are exempt as a result of the statutory provisions for exemptions. In Member Self-Service, when you prepare an estimate and a potential spike is found, a pop-up screen appears to explain that a potential spike has been detected, and then it explains what a spike is. The monthly amounts displayed will be assumed without any salaries modified due to the spike. Your final compensation is displayed on the results page, so you can see which salaries are causing the potential spike. In order for any pension spiking exemptions to be considered by our office, the employer must return Form 6487 in a timely fashion to our office. This form is sent to the employer at the time of your retirement. This form cannot be completed in advance of retirement, and we cannot modify the retirement calculation to reflect exemptions before you actually retire. Any adjustments will be made when we recalculate your retirement benefit, typically no sooner than 4 months after you retire. This could be longer depending on KPPA's workload. If it is determined that some or all of the spike salaries were due to one of the exemptions, we will recalculate your benefit. We will update your monthly benefit to reflect the corrected amount, and you will receive back pay for any difference between the amounts you've already received and the new payment amount. If there are no reported exemptions from the employer, your monthly payment will not change. If, after all exemptions are reported from the employer and there is still a spike on a retired member's account, KPPA will refund to the member any contributions received as a result of the salary that cannot be used in the final compensation. Looking back at our original employee, let's assume that did lead to a spike. The original pay was $18,695, and the adjusted amount for that year was $17,966.58. The difference in credible compensation for that fiscal year is $728.42, which cannot be used in calculating the benefit. As a result, we will refund 5% of that to the member, equaling $36.42. As you can well imagine, the rules, regulation, and history of pension spiking has led to many questions over the years. Here are some more frequently asked questions and KPPA's answers to those questions. When I review my high five, my last year or highest year is much more than 10% higher than the previous year. Why did it not cause a spike? Any exemptions due to alternate sick leave payments, trailing wages, or compensatory leave payouts is excluded from the spiking calculation. For example, the member seen on the screen has a large compensatory leave payment and a trailing wage. Those payments are not included when determining the amount subject to spiking. However, it does count toward calculating the retirement benefit. If I begin working for multiple employers and this leads to increased salaries, could this be considered a spike? Yes, unless one of the identified exemptions at any or all of the employers is applicable. I am a Tier 3 member. Can my salary spike? Since Tier 3 retirements are not based on final compensation, they are not subject to pension spiking provisions. Part of my final compensation was earned with KERS and part with Teachers' Retirement System. Will the creditable compensation I was paid by teachers be used to determine a spike? No. Only creditable compensation from CERS, KERS, and SPRS are considered for spiking. What if the spike occurred several years prior to the member's retirement? For example, the member had a spike in 2018-19, in 2019-20, and are in the final compensation. However, the member is not retiring until 2028. As the spike salaries happen more than 5 years before the retirement date, this would not be considered a pension spike. Most state employees have received 8% and 6% raises in 2022 and 2023. Can these lead to a spike? By itself, an 8% or a 6% raise would not lead to a pension spike. However, if there was any overtime work during these years that led to a greater than 10% increase from the previous year, it would be considered a spike. There is no statutory exemption for raises or salary adjustments. I am a state employee and I have received several Block 50 payments in the past. Would this lead to a spike? If the Block 50 payment led to a greater than 10% increase from the previous year, and this occurs in your last 5 years worked, it would be considered a spike. There is no statutory exemption for Block 50 payments. I am a state employee and I have a large amount of compensatory leave. Will this payout at termination lead to a spike? No. Compensatory leave payments at termination are exempt from the spiking provisions. When I look at my high five and find a spike, the salary that causes the spike is actually higher than 10% more than the previous year. Isn't the spike salary capped at 10%? Because every member is given a $25 exemption to the results of spiking in their monthly benefit, the salary of the spike year is manipulated to reflect that $25 exemption. I am required by my employer to work overtime due to short staffing. Will this cause a spike? As of 2022, the first 100 hours of mandatory overtime in a fiscal year is exempt from the spiking provisions. Any additional overtime pay will be considered, however, for spiking. Can my employer send in paperwork concerning my higher salaries before I retire? No. The final retirement paperwork has to be prepared assuming any spike and then corrected after the retirement. What if I have multiple years that spike? If you have salaries more than 10% over multiple years, there can be more than one reduction due to spikes. If there are 3 years in a row, the third year will be based on a 10% increase of the full second year's salary, not the reduced amount. For example, you had 3 consecutive years that went from $50,000 to $60,000 to $70,000. The $60,000 salary may have a spike as it exceeds the 10% threshold over the $50,000. The $70,000 amount would compare to $60,000, not the threshold amount of $55,000 that is calculated due to the spike. Should I turn down a raise or overtime since I don't want a spike on my pension? Well, consider this. You're still getting paid the money from the overtime or the raise on your current salary. That helps you now. Your retirement payment may not be as high as it would be without the spike, but it will certainly be higher as a result of the extra pay from all the overtime. It does not reduce it to something lower. This concludes our pension spiking webinar. I hope you leave today with a better understanding of how pension spiking works. It is a controversial subject, but we are here to help you understand how it impacts your retirement benefits. For more information regarding pension spiking, go to our website at kyret.ky.gov and click on Publications and Forums, and scroll down on the left to Member Pension Spiking Frequently Asked Questions. The KPPA staff and I will stick around as long as you need to answer your questions in the Q&A forum. This, of course, is intended for general information reference, so if you do have specific questions, please contact us at 1-800-928-4646. On behalf of myself and the other KPPA staff, we thank you for attending today's webinar. Thank you, and have a good day.